Hello, federal employees. This is Sierra with Plan Your Federal Retirement. Thank you for joining me on today's Fallout Friday, where I will be covering the highlights and action items from this week's episode. In episode 84, Micah and Joe Curry discuss Canadian retirement and retiring outside of the U.S. Joe is a financial advisor from Canada. He doesn't work with U.S. federal employees, but we have a decent amount of clients who have Canadian retirement accounts and have questions about it, or are even thinking about moving back to Canada post-retirement. If our clients have questions on it, then we thought we would have Joe on the podcast to answer our listeners' questions about it as well. Joe started us off by explaining what a Registered Retirement Savings Plan RRSP account is. It is a very common Canadian retirement account that they can put savings into to pre-fund their retirement and to get a deduction off of their income. Joe used the example of someone earning $100,000 and putting $20,000 into a Registered Retirement Savings Plan RRSP account. So they are paying taxes on the $80,000 that they made. The Registered Retirement Savings Plan RRSP is growing tax deferred. The main idea is that they will use this account to draw from in retirement to supplement their retirement spending. At age 71, it can happen sooner, but it has to happen by age 71. They have to transfer their account to a Registered Retirement Income Fund, RRIF, which is designed to create an income stream of withdrawals. By age 72, the minimum retirement withdrawals kick in. Another variation of this type of account is maybe someone who had some pension money and they ended up leaving. That pension money would be rolled into an account called Locked-In Retirement Account. It is a tax-deferred growth in there, and then again, it has to be moved over by age 71, and there's a minimum income. The only difference is that there's not only a minimum income, but also a maximum income withdrawal. Joe thinks that this is so that the pension retirement money is spread out over retirement and not all used up all at once. Micah asks a great question about access to the accounts before age 71, and Joe explains that you cannot withdraw from the account until age 55 unless there is a special circumstance like life expectancy issues or financial hardship. Micah follows up with another great question about the differences when the accounts move from the Registered Retirement Savings Plan to a Registered Retirement Income Fund, and what differences there are between them. Joe explains that the only difference now is that you can't put money in and you have to take it out. You can still combine the accounts together in most scenarios. However, you wouldn't be able to combine an Ontario locked-in retirement account and a federal pension account since they are not like-kind accounts. Micah has a client with a couple $100,000 in a Registered Retirement Savings Plan account, and they have been working in the U.S. for 30 plus years. But they may not want to retire back to Canada. Micah wanted to know what the client's options were since they didn't really like the Registered Retirement Savings Plan account. Joe explains that if it's in a locked-in retirement account, you wouldn't be able to take the funds out even if you really wanted to. With the Registered Retirement Savings Plan account, technically the client could take the money out, but there would be tax consequences and it would be considered income for that client. Joe brings up a good point that if the client is at their peak earning years, then it wouldn't be an ideal time to take out a couple $1,000s of additional income. Joe also says that you can't take it and put it into an IRA across the border either. The client is stuck with it in Canada until they want to start to take income or pull money into the account. Joe says that at that time, the advisor in Canada can hold the account for you, but they're not able to solicit advice at that point, and it will almost become a self-directed account. The client would need to go back to the advisor and give them direction on what they want to do with the account. Micah confirmed with Joe that once you leave the country and you have a Registered Retirement Savings Plan account, you cannot get advice from your advisor located in Canada. Micah emphasized that we like to get in the nitty-gritty with our clients and build a retirement plan, guardrails, and things like that. But those clients are going to miss that with their Canadian advisor. Joe took it another step further and explained that there is a limited advice, but also most institutions won't even open new accounts if they want to take their account somewhere else. Joe says that the client can take it somewhere that they can open a self-directed account, but then again, there would be no advice on that account. Joe emphasizes that before you leave Canada, it's a good idea to pick an advisor who you want to be with forever and set up a good portfolio. You can keep your retirement accounts with a Canadian advisor, but anything that's not a retirement account cannot stay with a Canadian institution, and it would have to be moved out. It all comes down to licensing, and Joe explains that he is licensed in Ontario, Canada, but if his clients move to Florida in the United States, he is not licensed to give advice in Florida. Micah adds on that this is good to keep in mind for any client. Once they retire and want to move out of the country, clarifying with the client if they are permanently moving, or is this just travel on an extended vacation, and they are keeping their U.S. residency. Joe explains that if the client is a Canadian citizen and you're coming back to Canada to maintain your residency, then the advisor is still able to help you and give advice on those accounts. Joe and Micah talk about the similarities and differences between U.S. and Canada and considerations for retirement. Joe brings up healthcare and how different it is, and that there is good healthcare in Canada if you are a citizen resident. The biggest downside is that wait times can be a big issue. For example, if you need an MRI, you may be waiting a few months. They try to do their best by prioritizing by scenario, but there are still issues with regard to wait time. Joe said it could be 12 to 24 hours before you can even be seen by a doctor sometimes. A lot of that has to do with the fallout from COVID and healthcare worker shortages. His local hospital has 400 to 500 job openings. For in-home long-term healthcare, you may have to go to private, and then that can be upwards of $10,000 per month. Joe explains that you could get a private room for $3,000 a month, but if you can't afford that, you still get care, but you may not get a private room, and you may not even be able to pick where you end up. It's based on income, so if you have no income or under a certain limit, that's when they will subsidize. Micah explains that in the US, we have Medicare that happens at age 65, but we also have Medicaid where that is income-based. You would have to also pay out of pocket for long-term care, and that health insurance does not cover long-term care in the States. Micah also explains that there's something called a Miller's Trust as well, where you have to have less than $10,000 in your bank account, still have your home, but there's other restrictions, but basically you have no money, and then the state would kick in and pay for long-term care. Micah brought up the question of private insurance, and Joe explains that there are some things that aren't covered. For example, experimental treatments. There are some other programs that you can apply for that are income-based. And Micah asked about secondary insurance, and Joe answers that the healthcare system in Canada was designed to be one tier, and there are some gray areas of what's available privately, which is really expensive and in most cases not covered by any kind of insurance. Micah recaps by saying that these are the types of conversations that we should be having with our clients if they're thinking about moving somewhere else in retirement, and thinking about things like medical care and if that location is going to be able to provide you the level of care that you want. Do they need a separate account for medical costs and flying somewhere else to get treatment? Something to think about is if they need a separate account for medical costs and flying somewhere else to get treatment. Joe agrees that planning ahead in retirement is the key. You need to plan the finances, where you're going to live, and healthcare. Micah brought up the example of a client coming in for an appointment and saying that they read an article that talks about the 5 best places to retire, and the client saying they want to move to one of those places. Micah likes to follow up and say, great. Have you been there? Have you met anyone from there? And what other due diligence have you done in advance? Micah has a client that's going to be moving to Japan in a few months, and his wife is also from Japan. They have spent the last 2 years evaluating things like how do you renew your U.S. passport or get something notarized. It's not impossible, but it takes a little bit more of due diligence to find out how it's possible and what that commitment is like. Another example that Micah brought up was that some banks in Canada don't even do U.S. notaries like a U.S. bank can. Joe adds that there's also a currency risk that is different than when you're just traveling. 2 weeks is a lot different than the next 20 years of your life. This podcast is all about action items for our listeners. Micah's action item is to think about where you want to live in retirement, whether it's a different state, city, country, or if you're going to travel abroad. Action item 2. Joe's action item is kind of picking off of Micah's, but if you don't know where you want to live in retirement, to start coming up with a list of your top 5 destinations of where you think you might want to live. Start looking into what healthcare looks like, tax consequences, and what's going to happen with your retirement accounts. For the third action item, Micah has an additional action item, which also piggybacks off of Joe's, and that's thinking about your healthcare plan in retirement, whether you're moving or not, thinking about long-term healthcare and healthcare plan. Micah's additional action item is also piggybacking off of Joe's action item, and that's thinking about your healthcare plan in retirement, whether you're moving or not, thinking about long-term care and health insurance. 5, re-listen to the original episode to hear the amazing conversation between Micah and Joe. 6, share this podcast with a friend, and with your help, we can achieve our goal of helping 1 million federal employees just like you. Until next time, happy planning.